Today we are going to discuss the concept of the bad debts. How we are treating those bad debts in the financial statements and what are the effect of the bad debts on the financial statements. First, we have to understand the concept of the bad debts. For example, the company has a receivable and the customer has, due to any reason, like it may be emergency, it may be some death of the customer, or the customer is insolvent or bankrupt, or simply the customer is unable to pay the money, so the company is unable or the business is unable to receive the money from the customer, so they have to write it as what, as the bad debt. So first of all, it is simply the expense, and expense means what? Expense is decreasing the income. Okay. The second effect, obviously, it has an effect on the account receivables, means it has an effect on the assets of the company. So on the assets of the company, what is the effect? Obviously, it is again decreasing the account receivable, or what we say the debtors of the company. Now, how to deal with the bad debts means how we are recording these bad debts in the financial statements. We have two methods. First of all, we have simply write off. Write off means what? That we are just writing it off from the books of the accounts without creating any provision or without creating any other amount. So simply the bad debt amount will be debit, and the amount of the account receivable, let's say Mr. X account is there, so that will be credit. So that amount is debited and the receivable is credited. So this is what we are writing it off, directly writing it off from the books of the account. Now the other method that we have is the concept of the provision. Now for that, we have to create a provision. Provision is simply an estimate for the future losses or for the future expenses, where we are not sure the amount, but we are sure that there will be a loss. But how much will be the loss? It may be more than the provision, it may be less than the provision. So it is just an estimate for the future expenses. So as per the concept of the conservatism, any future losses will be recorded. So in concept of the provision, what we do, we create a provision for that. Again, here we have a bad debt that will be debit, and then the provision will be credit. Provision for doubtful debts, it will be credit. Now it is estimated at the start of the year for the next whole year, means we are estimating that how much will be the expense. Now actually, when Mr. A, Mr. B, Mr. X, whatsoever is the customer, so they are bankrupt or they are insolvent, so then at that time what we have to do, we have to write off the receivable. So at that time what we will do, we will do the provision account, provision for doubtful debts, it will be debit, and then here the account receivable, let's say Mr. X is there, so that will be credit with that amount. So this is the concept, that either we can write it off directly, so bad debt will be debit and account receivable is credit. Otherwise what we can do, we can simply create a provision for that. It will be estimated amount based on the estimate, like a 2% of the receivable, 5% of receivable, based on what, on the past experience. And then when actually the receivable is write off, when we have to write off the actual receivables, when we are confirmed that Mr. X, Mr. A, Mr. B, Mr. C, whatsoever is the customer, they are not paying, they are insolvent, they are bankrupt, or any other reason they are not paying, when you are sure. So at that time, what we have to do, we have to, provision will be debit and the account receivable at that specific customer will be credit. So this is the concept of the bad debts. I hope you have understood the concept. Thank you very much.